Let's talk about the oil and gas space. Quite a few developments to take and focus on in the sector. We have an analyst joining us, Dayanand Mittal, oil and gas and telecom research analyst at JM Financial Institutional Securities. Dayanand, good to have you with us here. Good morning. Thanks very much for your time. Before we get into some of the individual stuff, but just want to get a quick sense from a budget perspective. Should we expect anything for the oil and gas sector? Realistically speaking, I mean, there is, of course, with regards to gas, some conversation which has been brewing. We sort of quizzed the MGL management recently around those. Well, we hopefully something will come through. But your sense?
Yeah. So from budget perspective, obviously, gas sector is one space where there's a lot of expectation around providing relief or boosting the gas consumption story in India. Given government has earlier announced plans to increase share of gas in India's energy consumption from about 6.5–7% currently to 15% by 2030. And this is being not happening at that pace because of the surge in global gas prices. So government is trying to find ways by which they can make gas more affordable domestically, either by way of including gas in GST, though it may not be a part of the budget, given GST committee's authority will decide on this. But yeah, any indication from the finance ministry on during budget before that on what's the status, that would be key. Second thing, what is within finance ministry's domain is probably cutting the excise duty on gas from current around 14% in case including within GST framework will take its time. So that could be a temporary relief before they can get all the states together to agree to include gas in GST. So that could be one big thing that is expected from the gas sector. Apart from that, I don't think there's much divestment. Oil Ministry has ruled out, so nothing much there. Windfall tax, I think that might mostly continue. So again, I don't expect any changes on the windfall tax regime, given crude price is around that $80–85, which is decent, but not low from government's comfort perspective. Yeah, so that's the key expectation, I guess.
Hi Dayanand, good morning and good to see you. When I wanted to focus on ONGC and Oil India, after a very long, they have come back, and in fact, both those two stocks are the biggest gainers in the last 3–4 sessions. Let's focus on ONGC because that was the big mover yesterday. We know valuation-wise there is comfort, dividend yield as well. We know the street is waiting for volume growth. What are you penciling in terms of volume growth for the next two fiscals? Because that's been lagging in the past, and the management I think is indicating a 5–6% volume growth. What are you penciling in?
Yeah, so both these stocks, volume growth has been a key structural concern for both the names, given the matured nature of oil and gas fields that they own, where you see a natural decline of 5–6%. So even they keep exploring new fields, that only goes to offset this natural decline. So overall production continues to be subdued. But after a long time, both the companies have few blocks which will contribute to growth. First, ONGC's KG-DW98/2 block, which has been long overdue, that will finally commission and ramp up from 3Q FY24. And that can probably add about 15–20% to ONGC's production over a three-year time frame. Given the not so great track record, we are conservatively building more like a 10% volume growth over a 3-year time frame for ONGC. For Oil India, there's a massive growth opportunity, but first on gas side, because of the new Indradhanush gas pipeline, which is gradually going to commission over next year or so. That, as per management, can increase the production by almost like 40–45%. But given the usual delays in pipeline, not so great track record, we have conservatively assumed probably they'll be able to deliver at least half of this in 2 years, and probably they'll get to what they're guiding over a 4–5 year time frame. For crude, Oil India, there's no block per se which is going to drive this, but yeah, there are a lot of IOR, EOR activities which they are doing, which can increase their crude production by about 10–15% over a 2–3 year time frame. So after a long time, we can see probably a 3–4% annual production CAGR over next 2–3 years. So that's the key story, apart from the fact that OPEC is keeping oil price high, which gives comfort on that $75 net crude realization. So yeah, these are the two key stories apart from dividend yield, which you mentioned.
So, the sector on the upstream side, is ONGC the pick for you, Dayanand?
So I would prefer Oil India, primarily because the volume growth story is much steeper in case of Oil India, something like a 40–50% production growth, In case of gas, if you assume pipeline comes on stream, demand ramps up. And for crude, about 15-20%. So overall, about 30-35% production growth is possible in the next 3-4 years. For Oil India, for ONGC, that number is more like 15-odd%. So Oil India would be preference. Second key reason for Oil India's preference is they have 70% odd stake in NRL refinery, which is tripling the capacity from 3 million to 9 million tons. And there's a huge excise duty benefit being located in Northeast. And that excise duty benefit is likely to continue even for the expanded capacity. So they've got a huge, about $10-15 extra GRM which they make in this refinery vis-a-vis what the industry GRMs are.
On the downstream side, I mean, is there a case to be made to be buying any of these oil marketing companies?
So our preference has always been we prefer upstream PSUs over OMCs. Primarily because we think oil marketing companies' valuations have gone out of the historical band. Historically, HP, IOC traded about 1x price to book, BP around 1.2, 1.25. They're trading now at about 10-20% above historical averages. We have a sell rating on HPCL and IOCL primarily we believe because last 2 years, FY23 and FY24, GRM were very strong because of a lot of supply outages and one-off factors. Though we expect GRM to be robust, but unlikely that those strong GRMs of FY23-24 is likely to be repeated. Second, on the marketing margin side, few in the street are building in bull case assumptions of marketing margin further rising from the historical levels. We see that as a key risk, given the weaker mandate for the current government, given crude price is likely to be around the 80-85 band, which is at the edge. Any spurt in crude could put marketing margin under pressure. And also the biggest structural concern on OMCs is the huge capex that they are laying. Though over a 15-20 year period, this might prove to be profitable, but in the near term, next 5-10 years, given the time and cost over them, they usually tend to be value destructive.
Just one last brief question, and moving away from oil and gas. You track telecom as well, Dayanand? And what's the pick there? I mean, there's this AGR news that we were discussing earlier with Balaji of IIFL. Quick thoughts there? Yeah,
so in telecom, our top pick is Bharti, Reliance because of Jio and retail. We have a sell rating on Vodafone Idea and a hold on Indus. Though this news, in case Supreme Court gives this verdict in favor of telcos, logically that favorable decision makes sense given the arithmetical error that was involved. And given the previous decision of Supreme Court was a bit harsh in terms of penalty and interest on penalty. So assuming this decision comes in Vodafone and Bharti's favor, for Vodafone, the debt relief could be in the range of about 35,000 crores, which is about half of their 70,000 crore AGR dues. So given the EV won't change, assuming no changes in assumptions, this 35,000 crore could translate to equity, which if I do a rough math, can add about 5 rupees to the target price. For Bharti, that number would be more like 20,000 crores. So given its huge size, probably it's a 1 or 2% addition to its equity.
Got that. Dayanand, thank you very much for that. So any potential relief on the AGR dues can boost the fair value of Vodafone Idea by nearly 5 rupees. That's the word from GM Financial and IIFL, just going mathematically.